Welcome to the cutting edge of the global awakening.
In the councils of government, we must guard against the acquisition of unwarranted influence by the military-industrial complex.
Well, it looks like the North Tower of the World Trade Center has just completely collapsed.
The U.S. dollar's status as the preeminent reserve currency is under attack.
This is a mathematical fact. Tens of trillions of dollars are being extracted from the United States of America.
You really want the truth? Then just follow the money.
Welcome to Follow the Money Radio, a broadcast dedicated to your personal, spiritual, and financial liberty. And now, here's your voice of reason in the midst of global chaos, economist and best-selling author, Jerry Robinson.
Greetings, friends. It's good to be back with you. Merry Christmas and a Happy New Year to you and your family from ours. So glad that you're tuning in today to join us on Follow the Money Weekly Radio. I have a lot of exciting things coming up in 2014. We're going to talk about that a little later on. But first, we're going to get right into things, talk about these markets in response to the Federal Reserve tapering. Now, I admit, I was on this program telling you that I did not believe we were going to see a taper. Of course, I was saying that all year. And I must admit that the December taper did surprise me. As I dug down deep into the statement, and I began to look at really what Bernanke was having to say about the economy and about the taper, it took away some of my confusion. It helped me to understand exactly what the Fed might be thinking, and therefore I wasn't as surprised. But when I first heard the announcement that they were going to cut back by about $10 billion per month, I got to admit I was fairly surprised. Now, this is kind of old news, but we've been gone for 2 weeks for the Christmas season. So what I want to do is I want to play you about a 90-second clip, kind of a mashup of Bernanke's entire press speech. So let's roll that, and then I'll have a few comments. Roll the tape.
The committee decided, starting next month, to modestly reduce the pace at which it is increasing the size of the Federal Reserve's balance sheet. The committee also clarified its guidance on interest rates, emphasizing that the current near-zero range for the federal funds rate target likely will remain appropriate well past the time that the unemployment rate declines below 6.5%, especially if projected inflation continues to run below the committee's 2% longer-run goal. Notably, despite significant fiscal headwinds, the economy has been expanding at a moderate pace, and we expect that growth will pick up somewhat in coming quarters, helped by highly accommodative monetary policy and waning fiscal drag. The job market has continued to improve, with the unemployment rate having declined further. At the same time, the recovery clearly remains far from complete, with unemployment still elevated and with both underemployment and long-term unemployment still major concerns. As you know, we've been purchasing $85 billion per month in longer-term Treasury and agency mortgage-backed securities. Starting in January, we will be purchasing $75 billion of securities a month, reducing purchases of Treasuries and mortgage-backed securities by $5 billion each. It's important to note, though, that even after this reduction, we will be still expanding our holdings of longer-term securities at a rapid pace. If the incoming data broadly support the committee's outlook for employment and inflation, we will likely reduce the pace of securities purchases in further measured steps at future meetings. The Federal Reserve's enhanced guidance about its policy intentions and a substantial and still increasing holdings of longer-term securities will ensure that monetary policy remains highly accommodative, consistent with the pursuit of its mandated objectives of maximum employment and price stability.
Okay, so just from a basic reading of all of the Fed statements, all the policy statements, everything that came out, the speech that was given, the questions, the answers, here's really what we take away. Number one, the housing sector remains a major problem for the Fed. And this is really important because Janet Yellen, she has made it very clear that unemployment and housing are going to be two of her predominant focuses during her tenure. So the housing sector is a problem. It's not moving the way that they want it to move. Secondly, inflation is still too low for the Fed's taste. And this is part of the reason why this taper surprised me. In fact, it's not just here in the United States that inflation is low. We see inflation low across much of the developed world, and even into some of the developing world, indicating that we may be seeing more money pumping in the future, because if central bankers are scared of anything, it's not inflation, but it's deflation. They think they can control inflation. And to a certain extent, they are correct, because they can manipulate the interest rates and the money flows and the actual liquidity in the system. But when it comes to deflation, when prices are falling, that's something that's very scary for a central bank, because they can't quite, they've learned, especially with Japan, they've learned over time that you cannot force the consumer to do anything, even through certain types of policies. You know, during times of deflation, prices are falling, and so what's the motivation to buy today? Because if prices are falling, then we'll just buy tomorrow. But then, wait, tomorrow they're going to be lower than they are today, so let's wait again. And so you have this delay of purchases that go on in a time of deflation, and that's a terrible situation. And I brought up Japan because Japan actually went through that crisis. There was a time in Japan's economy just a handful of years ago where they actually had negative interest rates in a desperate attempt to get the economy out of a deflationary funk, because people were not borrowing, they were not spending, and so the only way to get people to borrow was to actually pay them an interest rate. Now, that's absurd, isn't it? But that's the links that sometimes these central banks will go to. So we have the housing sector, it's a problem. We have inflation, which is still too low for the Federal Reserve's taste. By the way, the Fed's inflation target is around 2%. Anything below that number, Bernanke has gone on record saying that, quote, it could pose risks to economic performance, unquote. So the idea is, let's keep that inflation target right at 2% and let's hit it. And we're currently below that on a official government data record. Now, I mean, if you walk into the store, you certainly know that inflation is higher than 2%. If you look at some other indicators, you'll discover very quickly that inflation is much higher than 2%. Additionally, Bernanke went on to say that the political gridlock over America's most pressing economic issues is restraining economic growth. So what he means by that is the fact that we have not seen a commensurate fiscal policy approach like we have monetary policy. What's the difference? Well, monetary policy is when the Fed starts doing things, when they start cutting interest rates, or whenever they print money, or they do bond buying programs like they have with QE 1, 2, and 3. Okay, and when I say when they cut interest rates, I don't really mean that they can cut interest rates. They really don't. They just cut the target rate, and by cutting the target, they're able to manipulate the underlying interest rate. Now, fiscal policy, on the other hand, has nothing to do with the Fed. Fiscal policy has to do with the Congress and the President and the Senate. I mean, basically, it's laws that are put into place designed to stimulate or in some way affect or impact the overall economy. Remember the $787 billion bailout that occurred underneath George W. Bush. That was an example of really poor fiscal policy, but fiscal policy nonetheless. Well, we haven't seen much in the way of fiscal policy, and the way that the Fed looks at this is they say, look, we do our part, and Washington does their part, and somehow we make all this work. Well, it's been a very lopsided boat in the fact that the Fed has been pumping in money, they've been keeping interest rates low, and yet during this whole time, Washington has not been taking advantage of this easy money time by providing, in passing, laws and policies that would encourage growth. Now, I'm not of the opinion that we need any more policy out of Washington when it comes to bailouts or anything like that. Of course not. I was against all of those from the very beginning, but The point is that Bernanke is pointing at Washington saying that the political gridlock is making my job difficult. I can't get things done. I mean, I'm doing everything that I can, but Washington is not helping me. So he points out that the only way to deal with this gridlock for him and his successor, Janet Yellen, is to adopt what they call, quote-unquote, appropriate policy accommodation. That translates into perpetual easy money policies. So for the Fed, they're going to keep pumping, is what they're saying. They're going to continue to buy bonds, both mortgage-backed securities and government bonds. And they're also going to continue to keep interest rate targets extremely low for a very long time. All right, that's their plan. Now, their plan could certainly get away from them, but that's their plan. For the Fed, we should probably say that everything hinges upon an improved labor market outlook. They want to see the job growth return. They want to see housing do much better than it currently has. Overall, the U.S. financial markets had a very positive reaction to Bernanke's speech, to his policy, to the Fed's policy to cut by $10 billion what they were already pumping into the economy. So in essence, the sheer math breaks down to this. They were doing $85 billion. They were printing $85 billion and putting it into the economy each and every month. Well, now they're only putting in $75 billion. So that's the big change. And we expected that any announcement like that could cause the markets to drop. But what was interesting was the market seemed to have priced all of this in, and in fact, it almost exhaled in relief by jumping higher. We saw gold and silver, we saw stocks, oil, everything just popped. Everything went up. And this also was very bizarre because no one saw that coming. No one expected a taper, an announcement of a taper to drive equity prices up and gold and silver prices up. But the reason that it did was, I believe, is that it was just simply a relief rally. All of this anticipation and anxiety, all this buildup over a potential taper, and now it was finally over. The taper occurred. A very small taper at that, and very unlikely they're going to continue this. But nevertheless, it seemed as if the market just breathed out a nice exhalation. It was a nice relief rally that took place. So when you couple this news, though, of the taper, along with the fact that mortgage costs, not just rates, but actual mortgage costs are going higher in 2014, it means that if there's any takeaway from what the Fed has said, is that it's very important, if you're planning on purchasing real estate, buying real estate for your own purposes, for your own home, for your own personal residence, or for investing purposes, now is a very good time to be thinking about that. Not only do you have the incentive that the Fed is giving by keeping rates low, but who knows how long they can actually maintain control of those and keep them low. But second of all, mortgage costs for borrowers, especially those without big down payments and those with less than perfect credit, are going to be going up as early as next spring, because Fannie Mae and Freddie Mac, the two very large government-sponsored enterprises that have, buy most of the mortgages that are out there, they're raising their costs of doing business. They're raising their costs, and they're going to be charging more. You can find out more details about that on our website. We put out a briefing on that, a daily briefing on the coming increase in mortgage costs. But I tell you, now is a good time to be purchasing rental real estate or even your own home if it's something that you're ready for. I don't think that everybody should buy a house, right? I just don't think that's the case. There was an old idea back in the time of after the Great Depression, chicken in every pot. Everybody should own a home. It was almost like an inherent right. Everybody should own a home. And the fact is, a lot of people don't have any business owning a home because they move around too much, or they want to move around too much. You get a mortgage, you're stuck, In the Latin, the word mortgage comes from two words, mort, which most people know, mortal, that's the word meaning death, And that gudge, the last part of the word, comes from a word gauge, meaning grip or to hold on to something. And so really what a mortgage is exactly what it says. It's a death grip. You are held bondage in many ways to that mortgage for 30 years or more, however you set up your mortgage. Whether you refinance it or not, you're going to be paying on it for a long, extended period of time. And that's okay if you plan on staying in that area for a very long time, or if you have a house that can be resold in a very quick manner. But if that's not the case, then many people don't have any reason to be buying a house, especially if they don't fully know their future. They don't fully know what they're planning on doing. So it's a very, very important thing, I think, for people to really weigh that option carefully before just rushing out and buying a house because, hey, I'm 21 and I have my first job, and so now I need to buy a house. Well, that may not be the smartest move. And we should also say, though, that buying rental real estate should be viewed the same way, but the reasons for buying rental real estate are immense. They are immense. Today, we have what is becoming quickly a renter nation. People cannot afford to buy a house because they don't have a down payment. Many people don't even have savings, therefore they cannot purchase a home. Or they are just weighed down with a tremendous amount of debt. And you know that when you go get a mortgage and you apply for a mortgage, they look at your debt-to-income ratio. And if you have too much debt, you're just not going to qualify. So many of these people who today are young, they're getting out on their own, they're saddled with student loan debt. Well, they need a place to live too, and they're going to stay in a rental house. And so if you have rental houses in your particular town, you're going to do well. Vacancy rates are extremely low right now, and rental prices are only rising because the demand is rising. So I think one of the smartest moves many people can make is to purchase a rental house, especially if you're established, you know where you're going to be, and you know how to buy, especially if you have some extra cash. You can go and you can put a decent down payment. I personally don't like to put a large down payment down on a house because I like to keep my cash. I would prefer to have the mortgage or the note as opposed to having the equity in rental property. And that is because why? Because I want the renter to pay off my equity. I don't want to pay my equity. I want the renter to pay it. So regardless, now based upon what the Fed is saying and based upon what we know about the future of mortgage costs, and rates can only go higher from here, making it even more difficult for people to purchase homes, making it more likely that they're going to be looking for a rental house. The rental market is going to remain hot, I believe, for a very long time. So to sum all that up, with America increasingly turning into a renter nation and mortgage rates nowhere to go but up and mortgage costs nowhere to go but up, now, in my opinion, is a very good time to scoop up cheap rental properties before the rates become higher and the rules for borrowing become even more strict. But there's no doubt that investors are already out in full force, according to Realty Track, who monitors a lot of what's happening in the real estate market. All cash purchases accounted for 42% of all sales of residential real estate last month, November 2013. Can you believe that? 42% of all houses that were sold in the United States of America last month were sold for all cash, meaning there was no mortgage involved. Doesn't mean that the person had all the cash up front, necessarily their own. A lot of these people are foreign buyers, so they may have had the cash. But what's actually cropping up today in this low interest rate environment is that many grandparents and older parents are loaning money to their children or to others to buy a home because they can get a better interest rate from loaning on the mortgage than they can from putting the money in the bank or risking it in the stock market. And so we're seeing the rise of consumer lending, peer-to-peer lending, so to speak. And so this is a very interesting trend that I'm actually going to be talking about a little bit next year in 2014. There's websites like prosper.com. I don't know if you've heard about this, prosper.com, lendingclub.com. I'm actually going to be bringing on a gentleman who's going to be talking about that, how all that works, and it's all very interesting and potentially lucrative. But my point is, to those of you who have yet to refinance, if you have not refinanced a home or you've not purchased a home but you've been wanting to purchase a home and you're just not sure when to pull the trigger, now is a good time. I don't know what you're waiting for. Rates are not going to go much lower than they are from here, and costs for borrowing are only going to go up. So I think now is a very good time to pull the trigger. Let's shift gears for a minute. Let's talk about stocks in particular in the financial markets. There has been a lot of talk in the financial media about the next market crash. A lot of people talking about when is the market going to crash. It feels as if we're getting into some very frothy, to a very frothy environment, doesn't it? It feels as if we're getting into a very heady environment. There's just too many people who are starting to really jump on the stock bandwagon. Well, there's no doubt about it. The crash is coming. I mean, there's just no doubt about it at all. Everything that goes up goes down. Right now, investors are overly optimistic. For example, according to the closely watched Investors Intelligence's bulls and bears ratio, bullish advisors outnumber bearish advisors by more than 4-to-1 ratio. So for every 4 guys who are pushing stocks and saying they're a great thing to do, 1 is saying don't. Now, you always have people on both sides, but when it gets that out of whack, 4-to-1, it's rarely a good sign. But let me tell you something else that's rarely a good thing, and that is to argue with the market. Arguing with the financial markets is a fool's game. You may recall the famous quote by famed economist John Maynard Keynes when he said the markets can remain irrational longer than you can remain solvent. And that's very true. Markets can be extremely irrational, as we have seen as of late, right? We don't have a whole lot of reason to be breaking out to brand new highs on the stock market, aside from the fact that all this money has been pushed in. And of course, that makes sense, right? But from a fundamental perspective, people who are saying, oh, the corporate profits are so high and the economy is really taking, I mean, that is just not, there's just not a lot of accuracy to much of what is being said on the fundamental side driving the stock market. So we're in some irrational times. The same thing can be said for gold and silver. The demand is not down, right? But the prices are. So we're in a very distorted place. And this is what the Federal Reserve policy creates. It creates distorted markets. This is something we've been saying for a long time. Friends, the distortions that come from Fed policy are staring both of us in the face right now. We are seeing the fruit of the Fed meddling too much in the markets. And this is why we don't want the Federal Reserve to stick its nose in the economy every single moment of the day. We want it to take a hands-off approach and not be so aggressive in everything. Now, realize that if that's what we want, it's going to mean that we're going to see some tough times. But that is what's required, right? Just like every person gets the flu every now and then, every person gets a cold every now and then, it's natural for the economy to run its course whenever it goes up and then it comes back down. If you force the markets not to come back down, every time they try to come down, you push them back up and keep pushing them back up, you're creating a monster. That's kind of like there was, remember that there was some sort of technology that came out and ended up kind of being scary, but people were complaining about sweating. And so they would say, well, let's just put this certain stuff on your underarms and do a little surgery and it'll stop your sweat from coming out. Well, where is it going to go, right? They say that they're taking out the sweat glands. Well, in reality, that's not a very smart idea, is it? I mean, you're messing with a very basic biological function. And that's really what the Federal Reserve does by trying to artificially stop the downside of the market. You have to allow it. And if they would allow it, then it wouldn't be nearly as bad as it's going to be. But yes, a crash is absolutely positively coming. But let me tell you this. I have been a stock investor and a trader for, 15, 16 years. And during that time, most of my losses have come as a result of what? Attempting to argue with the stock market. Almost every single time, that I have had a major loss, it's been a contrarian play. That is, I'm going against the market. Now, I'm not saying there's not a lot of money to be made by being a contrarian. I mean, there's a lot of guys who make a lot of money, and I know many of them, and they make a lot of money being a contrarian. But myself, I'm a contrarian on a number of fronts as well, like uranium, for example. But when I make a contrarian play, I always use heavy technical analysis. I'm always looking at the charts, and I'm always making sure that I'm entering at the right time and exiting at the right time. You don't want to try to catch a falling knife. Perfect example, gold mining right now. Gold mining, yes. Do I believe gold mining is going to go up? Absolutely. Has it been beaten to a bloody pulp and it's down for the count? Well, no, it's going to come back. But if I were to buy gold mining stocks right now, it would be a totally blind buy, because it's like trying to catch a falling knife. I don't know when this is going to bottom. Therefore, I wait for the trend to tell me. I wait for our trigger trade system that we've created here to tell me when it's time to re-enter gold mining and silver mining. But I brought up uranium for a reason. One of the ways that I like to play uranium is through the world's largest independent uranium miner, Cameco Corporation, ticker symbol CCJ. Now, from 2004 to 2007, and by the way, I have some charts on our today's show notes, and I would encourage you to go over there if you're into the stocks and trading. We've put together some charts for you to check out, just as an example and as a kind of a instructive piece. But from 2004 to 2007, CCJ, the Cameco Corporation, this uranium miner, ran from a low of $6.86 up to a high of $53.28. That was a gain of 677% in just about 38 months. Now, since hitting that peak back in 2007, Cameco has fallen and it's failed to rise to those levels again. Of course, the stock was hammered in the wake of the tragic Fukushima nuclear disaster as nations began to swear off nuclear energy. And today the stock stands at around $20.50 roughly. And it's been locked in a sideways up and down channel since about late 2011. Now, I still trade, and I'm telling you all this about the contrarian side, because usually when I'm wrong about the markets, it's when I'm trying to go against the markets. It's just a fool's game, as I've said. Going with the markets, following the trends, this is where I've made my money. I've lost money trying to go against the markets. I've made money going with the markets. So guess what I do most of the time, right? I usually go with the markets, and I use heavy technical analysis, that is charting techniques, to know when to enter and to know when to get out. Now, I still trade Cameco, even though it's not, going up like gangbusters as it was from 2004 to 2007. But I don't buy blindly. I don't buy and hope. Right? I buy based upon the system that I've created, this trigger trade system. I was recently at a conference speaking, and someone came up to me and said, I've been using your trigger trade system now for a long time, and it has done so well. How are you able to pick the bottoms and pick the tops? And my answer was, we don't. We can't. It's impossible. Unless you have a crystal ball, you and I can never time the exact bottom or the exact top of a stock or even a market for that matter. As investors, as traders, the very best that we can hope for is to buy near the bottom and to sell near the top in any particular market cycle or any particular trend. But our trigger trading system does a lot of the heavy lifting for me. Therefore, I don't have to constantly be trying to find and spot those bottoms and tops simply by staring at a chart. Instead, we use our proprietary techniques to go in and find where the trend begins to start, and then we enter. And so you can use the trigger trade system that we've developed for long-term purposes. You can use it for short-term purposes, whatever the case might be. You can also use it inversely to make money when the market is actually going down. And that's what I love about the markets, is that it doesn't matter if the market is going up or if the market's going down, because you can make money regardless of what's happening, whether it's through options or whether it's through just selling a stock short. All of that we're going to be going into, by the way, in our Income University. For those of you who are not part of our FTM Insider Group, you can get access to all of this. Our Trigger Trade Report, where we get a daily stock every single day out to you. We have our Income University, which teaches you all of these things about stocks and other ways to make money. And also our general market indicators. And let's talk about that for a minute, because when it comes to the markets, we watch the big money. In other words, we follow the money. And to do this, we monitor the money flows coming in from both Wall Street institutions and small investors, although it's really mainly the institutional investors, the big boys, the mutual funds, the fund managers, the hedge funds. We want to know what they're doing, because elephants leave really big tracks, and they're easy to follow. And if you want to follow the smart money, you're much better off doing that than trying to figure out what the retail investor or the small-time investor is doing. It doesn't matter what he's doing, because he cannot possibly move the markets the way that the institutional investor can. Now, when we take a look at the overall market, big money flows are still occurring, and they're coming heavily into individual stocks, mutual funds, ETFs, and this is why our market light is still green. We also see big money flowing out of bonds. Now, I have an article here from CNN Money, best year ever for stock funds. Mind-blowing as I was reading through this. I have it right here. I'm going to read this to you. As memories of the financial crisis fade, the amount of money flowing into stock funds in 2013 has reached an all-time high. Investors put $346 billion into mutual funds, exchange-traded funds, that own stocks this year as of December 23rd, according to data TrimTab's investment research. That's more than the $324 billion investors put into these funds in all of 2000. So 2000, the dot-com bubble, got all these people putting their money in. But what we've seen in 2013 trumps the dot-com bubble as far as inflows into the market. And that was, by the way, the largest annual inflow on record, 2000. But we beat it this year by over $20 billion, $22 billion so far. And that's just, we still have a week left in the markets. The Dow Jones Industrial Average and S&P 500 are both up more than 20%, while the NASDAQ has soared over 30%. The Dow is on track for its best year since 2003, and the S&P 500 is on pace for its best year since 1997. This year marks a significant departure from the trend over the past few years. Investors yanked more than $150 billion from the stock market through mutual funds and ETFs in each of the past 3 years, according to the data from EPFR Global. So, in essence, if you go back and look at 2012, 2011, 2010, you will see that money was flowing out of the markets overall. It was a tough environment, and yet the market was still going up. But this year, we actually have a record amount of money going into the stock market. Many small investors, it continues, have been wary of stocks after being burned in the 2008 financial crisis. But the stock market has been on a bull run since 2009. And by the way, our general market indicator system here, the red light, yellow light, green light system that we use for our markets, actually called the 2008 crisis, to a T, getting us out. And in 2009, it showed us a green light. So we did not miss most of the upside. In fact, it's just been deadly accurate. This is why I got to stop this for a second, because I get a little concerned and, quite frankly, a little angry at those who are constantly telling you to pull out all of your money from particular asset classes like stocks or like ETFs or people telling you to put all your money into real estate or whatever the case might be. These are all negative things. As you know, we've been saying here over and over again for a very long time, you must be diversified across a various asset classes. You got to have many things going on in your portfolio, right? It's like a beautiful symphony. If you have a tuba in your symphony and that's it, boom, 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 or a trombone, boom, boom, it's a whole, and that's all you hear. That's not very pretty, is it? But when you lay in the violin and you lay in the trumpet and you lay in the bass and you lay in all these other musical instruments, it begins to sound very beautiful. And that's the same way with your investment portfolio. If all you have is one thing and then the rules of the game change, and that gets hammered, you're out of luck. That's why it's so vital to be widely diversified across various asset classes. Don't be afraid of stocks. Don't be afraid of those. Now, there may not be a reason for you to be in the stock market. Your age, right? You may be too close to retirement, or maybe you're in retirement, or maybe you have some other aversion that makes it very legitimate for you not to be anywhere near the stock market. But for the most part, there's a portion of your investment portfolio that should probably be in the markets in some form or fashion. And so, when I say that, we will we will get emails from people who say, Jerry, you're talking up the market. You want the market to do really well, and you're going to get people burned. No, I'm not. No, I'm not, because those folks who follow our work will tell you, and they've seen over and over again, that when the markets turn red, it usually is dead on accurate. And so we don't want to withdraw all of our money from everything except for a handful of assets and think that we're safe, because that's not safety. In fact, that is stupidity. It's the very opposite of safety. It's the very opposite of smart thinking and smart investing. Okay, let me continue on with this. Let's see, where was I? Many small investors have been weary of stocks since being burned in the 2008 financial crisis, but the stock market has been on a bull run since 2009, and individuals now seem more afraid of missing out on the rally. Okay, this year's gains have been driven by ongoing economic stimulus from the Federal Reserve, check, increased confidence in the economy, yeah, I guess, and solid corporate earnings growth to a certain extent, and more individual investors entering the stock market. That is true. The Fed announced earlier this month that it will modestly reduce its bond buying program in January, but many experts believe the bull market, which began in early 2009, will continue for a sixth year in 2014, albeit at a more modest pace. That is true. We are hearing from most of the experts that 2014 is going to be a better year than we have seen in the past, but probably not better than 2013. But remember, we don't have a crystal ball, so we have no idea what's going to happen next year. It could be a down year for all we know. All we know is we simply follow the money and pay attention very closely. Right now the market's green, and so now is time to buy. But whenever the market turns yellow, it's a whole different story. The story continues. It's almost over. Meanwhile, check this out. The bond market is on track for its worst year in history. Can you believe that? 2013, quite a year, isn't it? Investors withdrew $77 billion from bond mutual funds, isn't that something, and ETFs this year alone, making 2013 the worst year ever for bond funds, according to TrimTabs. This is the first time in nearly a decade that investors have taken more money out of bond funds than they've put into them. And it tops the previous record from 1994, when investors withdrew almost $63 billion. So you have to go back to 1994 to find anything even close to what we're experiencing now. We're seeing people pulling out of bond funds, and they're going long on the markets. So we could have a lot more up from here, but we sure need a pullback. I got to be honest with you. I'd love to see a nice 10 to 15% pullback before we go higher. I believe, from what I have heard from numerous sources, that the Federal Reserve is targeting a 20,000 on the Dow. They want to see the Dow get to 20,000. They want that mark to be crossed. They want the confidence levels to soar among investors. They want people to be opening up their 401ks and their IRA statements and saying, oh, wow, look how much money we made this month, or this quarter. Honey, let's go out and buy that new car. Let's go out and buy that new boat. Let's go out and take that vacation we've been putting off. That's what the Fed wants. They want the wealth effect. They want you to be out spending that money that you have, not hoarding it, keeping it, worried about what's going to happen in the economy. They're trying to turn the whole thing around. What is so terrible about all of this is that they're not going to succeed. They're not going to succeed in really creating a good, sound economy through their policy. All they're creating is another bubble. That's it. They're creating another bubble that you and I are going to watch deflate right before our very eyes, but we don't know when. And those who tell you they know when have a crystal ball, apparently. Either that or they're full of hot air, one of the two. And I think I know what the answer is, and I think you know what the answer is too. Because no one can tell you what the market is going to do tomorrow, let alone what it's going to do next year. So it's silly to try to predict where the market's going to go or forecast where the market is going to go, but we can tell you where the market is right now. And that, my friend, is a very important thing to know. And it's really all that you can know. Those who tell you otherwise are usually selling something very expensive. Let's see. One more statement here. Bond yields, in this article, goes on. Bond yields rise when prices fall, and prices have fallen a lot this year. The yield on the 10-year, check this out, the yield on the 10-year Treasury briefly traded at 3% on Thursday. That matches the highest level of the year and is up from a low of 1.63% back in May. That was very surprising to see the 10-year yield double since May. So we have had a lot of seismic events occurring in the economy. The biggest year ever for stock fund flows, the biggest year in bond fund outflows, a doubling of the 10-year rate. This is all very, very interesting to watch and important for investors to pay attention to. Now, speaking of the big money and institutional money and red light, green light, yellow light, and all that, how that works, a year or two ago, billionaire stock investor Warren Buffett was asked how he would approach investing if he did not have a lot of money. The question came during the Berkshire Hathaway annual investor conference, and Buffett gave a very interesting answer. It's very revealing. I'm going to play it for you right now. Let's listen.
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money.
Now, that's an interesting answer. You know, that Warren Buffett would say that you and I, if we have a small amount of money compared to him, you know, having billions of dollars, that we have an advantage. And the reason that we have an advantage is that we're more nimble. We can go in and we can spot opportunities. We can see the overall volume. We can figure out what's happening in the markets, and we can exploit it. And no one really knows, and no one really cares. Whereas when you are an institutional investor, you're a hedge fund or you're a mutual fund or you're Warren Buffett, and you make a buy or a sell, everybody and their dog knows exactly what you just did. And they care because you're Warren Buffett or you're that hedge fund or you're that mutual fund. So you and I can use the information that we see going on from Warren Buffett and from these hedge funds and the institutional investors in particular to know the trend, to pay attention to what's happening. And that's why we say elephants leave very big tracks, and they're very easy to follow through the forest. And it's just like anything else. I mean, in business, supply and demand rule everything. Stock prices are determined based upon supply and demand because the buying and selling that occurs on Wall Street is public knowledge and available to anyone through the internet. It's vital for you and I to learn how to interpret those demand and supply figures. These figures, by the way, are called volume. And learning to interpret volume in the markets is an extremely important skill and a very, what we should say, potentially profitable skill for investors. When buyers outweigh sellers, prices go up. And when the number of sellers exceed the number of the buyers that are present in the market, prices fall. Now, here at Follow the Money, what we do is we measure 10 different indicators at the close of each trading day to determine the general trend of the U.S. stock market. Which way is the wind blowing? Which way are the big money investors going? Are they buying or are they selling? Because you may see a bunch of volume at the end of the day, but is it good or is it bad? And that's what we measure. Right now, as you can imagine, our market indicator system is a full-on solid green. It cannot get any more green than it is right now, indicating that it's buy mode. However, this is going to change when the big money starts selling and locking in their gains. And when this happens, our market indicator system will turn yellow. And all of our insiders will receive an email saying, yellow alert, the market has turned yellow. Here is what we are going to do now. And then when the selling accelerates, or I should say if it accelerates, because sometimes it'll go to yellow and then go back to green because it's a false start to a downturn. But if the selling accelerates, then it will cause our market indicator system to turn red, and that will cause a red alert. All of our subscribers will receive, and our insiders, I should say, our FTM insiders, receive an email that says that the market is now in red alert. We have had those go out a handful of times over the last several months, and when they do go out, sometimes they don't pan out. Sometimes it's not, the end of the world by any means, and it doesn't mean that you should head for the hills and run and and get out of the stock market entirely. It means that we're in danger zone. That means that the big money has pulled out of the major markets that we're monitoring, and we are letting you know that the only thing holding up this market are the retail investors, and they're usually the last ones holding the bag. They're the ones who lose their shirts. The 2008 crisis was very clear to see coming. We were out there screaming about it across various stages across the country, in universities and colleges and churches, and anybody who would let us in the door, we were saying, you must listen to this message. 2000, it was as clear as day what was happening in the markets. In 1929, if we backtest our general market indicator system, we find out that it called the 1929 crash. I think we were in one day into negative territory before it actually triggered a red alert. So this system works. Now, of course, it's only for informational and educational purposes only. We don't want anybody using our system and replacing their financial advisor with our system. However, this is a great way to confirm your decisions with your financial advisor or with your own independent financial education system that you're using on your own. But this is what I love about the financial markets, is that it doesn't matter if it's green or if the markets are yellow, or if the markets are red. There's always a way to make money. With the markets going sideways, markets going down, the markets going up, you can make money in the markets through the uses of, we said, like options or selling short. Whatever the case might be, there are ways to make money in the market. And when the market does begin to flash that red signal and there's not at all clear, the red alert comes out and the email goes out, our proprietary trigger trading system will continue to provide our subscribers with profitable trading ideas. They'll just look differently. We'll be selling stocks or shorting stocks as opposed to buying them. And we'll also be using options as well in the near future in our trigger trading system. So anyway, with all that said, let's head over now to Jennifer Robinson. She's going to be here to give us an update on how our trigger trades did. Let's head over to that right now.
With this week's Trigger Trade Report, I'm Jennifer Robinson. Well, as we did not have a radio show last weekend, I will be talking about the last 2 weeks of activity in our trigger trading portfolio. We've sold 3 positions, including ticker symbol BR, for a 9.4% profit, ticker symbol CELG for 5% gain, and ticker symbol KFY for a little over 6% profit. We have 10 stocks still in play, and some of those ticker symbols include DE up 6% for us, ticker symbol STX up 10%, ticker symbol FB up 6%, and ticker symbol SID up 6.5% for us. We had one stock stop out at its stop loss price for an 8% loss back on December 18th. And we raised the stop loss price on 4 of our positions, including ticker symbol CECO, ticker symbol FB, ticker symbol STX and DE. We still have 6 stocks awaiting Jerry's trigger price. Trigger trading is a service we provide to all of our FTM insiders in which they receive a stock trading idea every single day of the week, complete with Jerry's trigger price, stop loss price, commentaries, and daily status updates. You can learn more at ftmdaily.com/trigger trade. That's ftmdaily.com/trigger trade.
Well, friends, that brings us to the end of our program. Thank you so much for tuning in on this very special holiday edition of our Follow the Money Weekly Radio program. It's always an honor and a privilege to be a part of your life each and every week right here on Follow the Money. And as always, I leave you with this final word. This time, I'm going to allow Edward Snowden to do the talking. This week, he delivered a televised Christmas message to the people of America, and I think you'll find it very interesting. Roll that tape.
Hi, and Merry Christmas. I'm honored to have a chance to speak with you and your family this year. Recently, we learned that our governments, working in concert, have created a system of worldwide mass surveillance, watching everything we do. Great Britain's George Orwell warned us of the danger of this kind of information. The types of collection in the book, microphones and video cameras, TVs that watch us, are nothing compared to what we have available today. We have sensors in our pockets that track us everywhere we go. Think about what this means for the privacy of the average person. A child born today will grow up with no conception of privacy at all. They'll never know what it means to have a private moment to themselves, an unrecorded, unanalyzed thought. And that's a problem because privacy matters. Privacy is what allows us to determine who we are and who we want to be. The conversation occurring today will determine the amount of trust we can place both in the technology that surrounds us and the government that regulates it. Together, we can find a better balance, end mass surveillance, and remind the government that if it really wants to know how we feel, asking is always cheaper than spying. For everyone out there listening, thank you and Merry Christmas.
Yeah, I believe that. Together we can find a better balance, end mass surveillance, and remind the government that if it really wants to know how we feel, asking is always cheaper than spying. What a soundbite. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. Happy New Year to you and your family from ours. God bless.
All of the information contained on Follow the Money Weekly Radio is strictly for informational and educational purposes. The views and opinions of all guests, including our sponsors Tom Cloud and Jay Peroni, are their own and do not necessarily represent the views of Jerry Robinson, FTMDaily.com, and or Robinson Media Group, LLC. Jerry and Jennifer Robinson do hold their insurance licenses and may offer consulting on life insurance and fixed retirement income products. Remember, never do your financial planning through podcast or by radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.